So the question is, should I get a MYGA or should I get CD? Hello, my name is Ryan Anderson, and this is Retirement Fundamentals. Thank you so much today. I appreciate you joining us. And today we're going to answer a question that was actually posed to us after one of our previous episodes. We had Paul Garofoli on here from The Standard, and he talked about MYGAs, multi-year guaranteed annuities, and CDs. And he did a great job about talking about the differences in these two financial solutions. The question we have today specifically talks about which one do I want? Should I get a MYGA or should I get a certificate of deposit or a CD at a bank? And the answer is, quite often, as many of these questions is, it depends. What is your solution that you're trying to find? What is the problem you're trying to find the solution to? I think would be a better way to ask that question. Now, the thing about it is that MYGAs, multi-year guaranteed annuities, are amazing products. Right now, generally the interest rates on them are a little bit higher. They're backed by bonds, and so we know that they're stable. And you can generally get these terms a little bit longer at a higher rate than you can from a lot of banks. Now, I used to be in banking back years ago, and so I understand how banks operate and how banks work. The thing about it is that when they go through, they can give you a nice interest rate, and most banks will do prime plus a percentage or prime minus a percentage, how they calculate their CD rates, because unlike insurance companies that generally use a bond to give a guaranteed rate, banks use basically loans that they make to other organizations to get that rate. If they can get a higher interest rate on the a loan, then they can give you a higher interest rate on the CD, simply because that's where their margins are at. And they need to have those CDs in on for a period of time on deposit so that they can make loans according to the different regulations that are out there for them. So the question is, should I get a MYGA or should I get CD? Well, the thing about it is it depends on what the purpose of the funds are. Let's say you're 60 years old and you're going to retire in 5 years. I've got this chunk of money here that I am not comfortable putting it into the market. I want to have a guaranteed return. My mindset is much more, I am not so concerned about winning big. I just don't want to lose what I have. So at that point in time, you've determined that one of these two solutions is best for you. Wonderful. We can help you with that. Take a look at the different processes. Take a look at the different terms. In 5 years, if I can get a 6% rate on a MYGA and I can get a 5% rate on a CD, go with the MYGA. If that same period of time I can get a 5% rate or 6% rate on a CD and only a 5% on the MYGA, go with the CD. But what happens if you'd like some flexibility? Most CDs, if you try to take money out, you're going to get penalized. Many MYGAs will let you have up to 10% of the principal without a penalty. So you've got an increased liquidity option. Some MYGAs will go through and they will let you have significantly more liquidity on it. If you're concerned about needing money for the future, that's an option to it. Both of them are time type of vehicles, so that you are going to be losing liquidity with that. So that's one thing to consider. The next thing is that generally, if we look at things, that there's kind of a cross path where they have there, depending on where the interest rates are. So if your interest rates, that the banks and the insurance companies aren't going to give you a guaranteed 5-6% for 10 or 15 years out, you might be able to get one for 4 or 5 years. So depending upon the term that you're willing to tie the money up for, that will be a lot of it. MYGAs generally are longer. I've seen a couple for 1 year. The majority of them start about 3 years. So if you want to get something for less than 3 years, a certificate of deposit or CD is probably the best strategy for that. Now, another thing that I've gone through and done is I've used a hybrid solution of both of these together. Now, this is really good, where you go through and say, I've got a 6-month CD, a 1-year CD, an 18-month CD, a 2-year annuity. a 3-year annuity, 4-year annuity, 5-year annuity, 6-year annuity, and I put $50,000 or $25,000 into each one of these solutions. And then as they come due each year, I can then take a look at it and see, do I want to put it into another CD, or the rate's really good, or do I want to tie it up for a longer period of time, or a combination of the two? I had a client here a while back that had $500,000, and they wanted basically to have about $50,000 liquid at any given time. Their definition of liquid is within a year. So what I did is I took $500,000, I broke it up into 10 equal payments of $50,000 each, and we put it in 1, 2, 3, 4, 5, all the way out to 10-year products. I used a combination of 3 or 4 companies to do that, and we had fixed rates on about 7 years of it, and the 8th, 9th, and 10th years, those were more of a fixed index solution. Those were in annuities that would give them a guarantee of no loss, but they had the ability to take gains when the market went up, or the index in this particular case, and not take a loss when it went down. So not a CD or a MIGA, but you can go ahead and you can take a couple of other solutions and work into a solution with that for you. So with that being said, having a combination of all these with you together is great for a lot of folks, depending on what kind of a problem you're trying to solve. Now, the thing about it, and I say this all the time, don't just go out there and look for products. Don't just call somebody who's going to offer you a solution right out the door unless they get to know you first. That is a huge deal. What is going on in your life? I went through and I had met with the folks a couple of years ago that wanted to have a great return. And they liked this a solution. They gave them 6 years, and I think that was an insurance product. I think it was a 5-year MIGA, a multi-year guaranteed annuity. Great return. Well, what they didn't realize is this was a 5-year term. They were thinking it was going to be 3 years, or they would be able to get money out if they needed to. There was not a clear explanation or a clear understanding of what the actual product was. Great product, bad application, because 3 years down the road, they knew they needed to have about $400,000 of that to buy a house, that they were going on the road and they were going to do the RV lifestyle for about 3 years, and they wanted that chunk of money to buy a house. Why would somebody put them into a 5-year product? See, that bothers me. So having somebody sit down and listen to you and talk to you and make sure that you understand what's going on before you get a solution to make sure that it fits for you is a big deal. Whether that's virtually, whether that's face-to-face, either works, but make sure they do that. That's the answer to the question, should I get a CD or a multi-year guaranteed annuity? If anybody else has questions, we love to answer them here. Please comment below, like and subscribe, and if you've got a question about anything retirement related, Social Security, Medicare, money, please send us a note and we'd love to answer it for you here. Thanks so much and have an amazing day.